Alrighty, good evening everyone. It is Monday, August 1st. I thought I would do my market recap this time via video so that you can see what I see, hear what I'm looking at. If there are any questions, you can always email me. But let's jump into our market recap for July of 2016. My name is Kevin Hurley. Pleasure to be managing money for you. But let me jump into one of the very unique Junes that I've ever seen in my lifetime. Throughout all of June, we had ridiculous numbers that came in. What do I mean by that? This is a picture of our, how would you say, last week's economic reports. The Case-Shiller Housing Price Index came in less than what was expected. Consumer confidence was at a high. Don't understand that one. While home sales are lower than expected, mortgages came in down 11% last week. Durable goods, the primer for GDP, came in much lower than expected for the third month in a row. Actually, for 2 out of 3 months over the last quarter. Pending home sales came in at 0.2 versus 1.1, significantly lower than expected. We had more people out of work. We had less international trades. GDP came in at 1.2%. For the first half of a year, our GDP was at 0.8. Plain and simple, none of the numbers this month made any sense. If we go ahead and we can go through this week's very busy week. The ISM index, the services index, came in at a 52.6 versus an estimated 53.1. Construction spending was expected to be somewhere between the 0.8 to 0.7 in growth, came in at 0.6. We're going to have probably some not as good as expected numbers. You might see some stocks head down this week, pulled down by the stock market. We really haven't had any good numbers this whole week. And on Friday, when we go through our average work week, our non-farm payrolls, this is kind of the recap for the month, where we're going to see, to a certain degree, just how bad a shape the U.S. is in. We also had the Grexit, where we're going to lose roughly, well, how do I say this? Most of what's being shipped overseas, at least to Europe, is purchased by England, so to speak. Great Britain, excuse me. And I guess the honest answer is the start of their demise is here. They just lost one of their 3 big funding members of the 31 country European Union. They just lost a third of that funding. So they're going to learn pretty quickly that it no longer works. You run out of other people's money. You can't support the weak or those that aren't able to literally contribute to the society over there. I think it was a good experiment, but you're going to see most likely in the next 2 to 5 years a breakup of the European Monetary Union. You can't have just Germany continue to fund, with a little bit of help from France, fund the European Union experiment. Some things that have come up, the Fed missed its opportunity to raise rates. In fact, it says the Fed missed its moment, doesn't know what to do, experts say. Obviously, the Fed is in this great experience with lower interest rates, somewhat ridiculous. American businesses lack confidence on the economy. Kramer says we need to prepare for August now, which is supposed to be the hardest month when it was supposed to be July. Wet oil back below $40 a barrel, so we might see oil back below the sub $2 range. And then it's kind of funny, one analyst was willing to say, hey, welcome to this bizarre world of oil and gas. In all reality, the only thing that makes sense in our stock market right now, and why it's not plummeting significantly, is that you can't fight the Fed. the Fed will continue to boost quantitative easing by reinvesting the mortgage-backed securities, by artificially propping up the dollar, by artificially propping up the economy. So the short and skinny, if there's anything I've learned in July, is that we are no longer going to be able to have the ability to literally expect anything, I guess, anything but continued sideways to maybe some upward movement, because the Fed is protecting us at this point. With that said, you'll see a couple huge down days. Big movements in the stock market. There's a 600-point down day. There's another 200 or 300. That was a Grexit. And shocking at how quickly it came back. That blue line is a 50-day simple moving average. The red line is a 200-day simple moving average. Unbelievable that it could break it so quickly on the way down and that it would come back up. Excuse me. In July, we had a first week where we had a big bounce on Friday, followed by a second week where we're just kind of leveling off. In all reality, we're seeing a precursor that our market's going down by crossovers on the MACD. We're seeing a pretty flat line right now in our stock market where it just seems like things are starting to cool down. I really, and I think all the market experts, would have expected our pullback in July, especially with the Grexit that occurred. Rather shocking that we are going to have our 6th consecutive quarter of lower S&P 500 earnings than the previous year, yet we still see the growth in our stock market. A unique phenomenon that has not ever occurred in our stock market, where we literally had 6 quarters of lower than the previous year earnings, and yet our stock market has gone up. Of course, we've got our general election. I think most of the world is curious to know who's going to win. Personally, I don't have a favorite here. I think both of them are not going to help us out. It'll be interesting to see if our stock market moves sideways until November and then reacts based on the election. It seems like right now stock market will go higher with Clinton because the stock market knows what to expect, and the stock market will probably go lower if Trump is elected. Alrighty here. Going to go over some of our stocks. Apple. We had Apple in a pretty good downturn before earnings. The week before went from 101 to 96. This is called a gap when we move higher from our blue line up. But literally we are seeing on Apple a bounce back. In fact, this bounce back, pretty interesting point to look at. Literally this bounce back from the earnings broke right through the 50-day, held support on the 200. We should go at least up to that 11.5 range. You'll see where we had a problem getting above that back in April. With the iPhone 7 announcement in September, that'll give us, beginning of September, that'll give us the reason to break that 111, and really about 120 is the next stop for Apple on the way up. Finally getting some upward movement. Great job in lowering cost basis or picking up shares here. Another great job of lowering our cost basis here, but we're finally getting our movement. It'll be interesting if, for those that own Apple, if that's the stock that helps us beat the S&P 500 by the end of the year, just to see it get back up to that 120 level. Baidu. Baidu, if we take a peek at this chart, laid an egg right here at earnings. Notice the bounce back, went right down to these lows at that 155, bounced right off of it, and up we go. we have a very tight range for Baidu, where it might wiggle between the 165, 167 range to the 155 range. Any bounce up, because this news that we got at earnings, we were actually told about it right over here. Any bounce above our blue 50-day, expectations for Baidu to go right back up to 185. It'll be interesting to see, because right now we're doing a little overpaying for protection on Baidu, but you can't overprotect enough when you're looking at China. Clorox, starting to look into some defensive positions. We may see some movement on Clorox in portfolios here in the near future, especially if our market starts to tumble. Clorox has their earnings on August 3rd, which is on Wednesday before the market opens. We're going to pay particular attention to Clorox. It has support sitting here at that 126 and 76 cents level, the 200-day. Expectations, though, Clorox is going to have pretty good earnings and should run back up to that 139 level. Let's see, next stock we're going to talk about, Disney. Unbelievable. We have a run back up to Disney that should take us at least up to $120 to the $122 range, maybe even the $125 range. But right now, Disney on $13 billion of earnings is worried about $50 million that comes from ESPN. They've done a fabulous job on the movies. In fact, if anything, with the Olympics starting on Friday, August 5th, you might see a bit of an increase in the ESPN subscribers, which they would have already had to have done to get ready for the Olympics. That might be the catalyst at earnings, where as long as their numbers show an increase in ESPN subscribers, you will see Disney very quickly run up to that $120 level, which would be an increase of $25. With shares that we've picked up on the way down, this would be a fabulous opportunity to be able to literally beat the S&P 500 year to date on one stock, and that would be Disney alone, that we could do on the next earnings, which is coming up for Disney on the 9th after the market closes. So that'll be next Tuesday. Ford. Well, apparently GM did everything right and Ford did everything wrong. Plain and simple, Ford will most likely come down to the $12 range. We've got the right up to sell it between $13.15, $13.75, and $14. We're going to pick up 10% more shares of Ford. In all honesty, this is where you root to see Ford in the next month or so head all the way back down to that $10.80 range. It'll be an obvious overreaction dumping that much of Ford, but that's going to allow us to pick up 20% more shares of stock for those who are in Ford. If it gets down to that $10.80 range, right now we should be able to pick up about 10% more shares of stock of Ford pretty easily with the movement down after earnings. Facebook. I had hoped to move money out of Apple into Facebook because of its opportunity. Good earnings. We came all the way up to the $128 mark, but notice how we reversed. If this doesn't show us anything about market uncertainty, a company that hit it on every single metric, every single cylinder, did everything right at earnings, had their stock pull back because of market uncertainty. Great opportunity for Facebook to go higher when we get some clarity in our stock market. Kevin, what do we have by clarity? Well, we need to finish out our earnings season. We need to see growth in the U.S. that we're just not seeing at this time. We need to see some stability in other nations, particularly the worry in regards to Europe. Any of those things come together and we see some stability, Facebook's definitely heading back up to that 128, 130 level, if not even higher to 135. Netflix, a couple people have asked me about Netflix. What are we doing and why? What's the plan on Netflix? Netflix is one that I'm typically not recommending to clientele. Very volatile, being up at the $111 range back in April. You can actually find it closer to 125 earlier in the year. Big moves down on earnings last time, obviously a big move down on earnings this time, but look at the move back up. Kind of unprecedented. Typically when you have bad earnings on Netflix, boy, I would have expected to get down to 85. Hey, bad news on their subscriber growth over in Europe, back down to 85. Well, it hit 85. This should have been where it should have went lower. Nope. Moved it all down in one day, working its way back up. Interesting to see where Netflix finishes its run up. Right now we're looking at about 101.53. In all reality, there's no reason why it can't get back up to that $110 range. Interesting to see what happens with Netflix. Nvidia, for those of the lower portfolio amounts, we've gone through some Nvidia. Pretty impressive to see it get up to 35, but you're going to notice at the top, overbought, which usually means that it pulls back. Not on Nvidia, ran all the way up to that $44, $45 range, and man, this stock keeps coming up. We are protecting profits right now in Nvidia. The other day I opened up profits into next year for Nvidia, giving us roughly a 10% return. Right now, any drop down, you're going to see Nvidia come all the way back down to that 35 level. There's just no support, no protection on Nvidia because it went up so fast so quickly. I'm doing a good job of protecting what profits we have in it, but Nvidia, rather unusual. You rarely, if ever, see a stock stay overbought like you see in the top of this chart for more than 2, 3, 4, 5 days. We have Nvidia for 2, 3, 4 months being overbought. A really unique scenario to see in a stock. It typically does not happen this way. Visa went through earnings again. Unique earnings, beat on all metrics, doing everything right. Went up to 80, back down, testing itself on the 50-day simple moving average. Pretty tight range between 82 and 78. We might see it just work sideways for a while until it starts to show some profits from its purchase of Visa Europe. And last but not least, actually I guess there are two more. Some people have asked about Verizon. Verizon is right now artificially being pulled down. Huge run up from 48 up to 56. But Verizon made the mistake of buying Yahoo. So it now bought a drag on its earnings. It'll lose money for the next couple quarters. I expect literally in the next 60, that's not true, the next 60 to 90 days, if not 6 months, to see Verizon come back down and test that $50 range. Verizon had pretty good earnings, and by the way, Nvidia has earnings on the 11th of April. Alrighty, last but not least here, the XLF. The financial sector is the sector that's supposed to take off when we have a rise in interest rates. We just can't get above 23.75-ish, really between 23.50 and 23.75. We're looking for an increase in our interest rate. Probably won't happen until December this year. I've always wanted to be in some banks when the Fed would start raising rates, but they're raising it so slow. The banking system is just truly hanging on by a thread. not making money like it used to. Any rise in interest rates can increase its profits by almost 50%. You're just not seeing big movements on banks right now as we sit and wait for the slow churn, no interest rate hike ability for the Fed. The Fed really does need to raise interest rates, so it gives themselves the ability when China and when Europe start to falter, they've got something to do to stimulate our market. So I pay a lot of attention to the XLF to see the growth in the financials and where they're heading. The financials typically lead our stock market higher. No growth in financials for over 6 years. It'll be interesting to see if when you start to see financials take off, it'll be the precursor to our market having the typical rallies or the typical rebounds that you've seen after a recession. This is really an unusual recession. This is the slowest rebound from a recession that we've seen in history. With that said, guys, I hope this gives you good help on understanding what I look at on a pretty constant basis, actually on a daily basis. If you do have some questions or want to talk to me, there are the ways to reach me. Again, don't hesitate to give a call, zip me an email. But there's our market recap for July of 2016. For August, a lot of worry in the air. So I've got most of our protection out till that last Friday in August. And I'm going to keep most of that in place just to make sure that that we don't get caught by something on surprise. It literally kicks our market down 600 points in a day, 400 points by morning or 500 points by morning. I would rather right now overprotect for our run into the end of the year than underprotect. There's so much risk to the downside, really being what, 6 years now, so we're 2.5 years overdue. I guess it's 8 years, being 8 years into our bull market, over 4 years overdue for our 10% to 25% pullback. The risk is definitely to the downside. Guys, I appreciate your time. I will have this out and ready for you guys and look forward to talking to y'all in the future. Bye-bye.